And good morning again. Now that we're approaching the year's halfway point, a few things have become clear. Things are changing. Growing trends towards globalization and market defragmentation have been met with geopolitical tensions and the aftermath of COVID-19. At the same time, our collective fascination with Web3 and the metaverse have become important implications for the industry and of the world. I'm thrilled to welcome 5 executives of the largest companies in our industry to discuss how these technological, social, and governmental changes are shaping the future. I welcome our moderator, Andrea Barriola Mateos, Head of Finance Bank Cyprus, to introduce our speakers. Welcome.
Thank you very much. Hello, working? Yes? Thank you very much, Tessa. Welcome, everyone. Glad to see that the room is full, even if it is this early. Welcome to all of our speakers, very seasoned executives. I'm very happy to host them here today. We have very exciting topics to discuss about, some controversial, some less controversial. Let's see how it goes. And we will open the floor for a brief Q&A at the end. We'll try to make it there because we have a lot of panelists, so we'll just get right into it. I'm going to open the floor by asking about current news, war in Ukraine. I would like to pick your brains in order to see how do you think from your perspective, your individual perspectives in this industry, how is this war affecting the fintech industry? Who wants to take it? Iskender.
Hello. I guess what we've seen on the back of the war is just further volatility into the markets. And what that has allowed us to focus on, or pushed us to focus on, naturally, greater volatility means greater volume. So it's about being able to withstand the volumes that will come through your systems, and it's a very interdependent market that we operate in. So you have to ensure that execution, slippage, latency, all of those elements are stress tested, and you have BCP setups in place to support that, because your LPs tend to be very risk averse. You have to be able to adapt and accommodate for that, have alternatives where necessary. We've seen a significant impact in commodity prices. We've seen that shoot up tremendously. And just being able to continue to make those commercial terms available to those underlying clients where the markets could shift and move in whichever way. I think that's been the key focus. I mean, if you think about the markets today, there's a lot of elements that are affecting that volatility. The war has just added on to that. And the war is very much a short-term impact, because in what we've witnessed, I think the wars tend to have a short-term impact. If you look at the VIX index, it's north of 30 today, or it was north of 30 about 3 months ago. Now it's consolidated below the 30 level. So we've seen that short-term impact come through, and we're on the other side of that. But it's the impact of central banks, interest rates, decisions, the impact of commodity prices, the impact of the pandemic as well. We still haven't recovered from that fully. So all of those have facilitated significant impact on markets. For us as brokers, it's ensuring stability in prices, stability in the commercials that we're offering on underlying clients.
Yeah, I was actually going to mention that commodity prices have gone up about 84% and fertilizers over 224%. So I'm wondering, from the retail perspective, has this increase in retail commodity prices affected not just the volatility of the volumes, but the amount being traded as in deposits? Is it the market becoming more conservative? Are you seeing a downward trend towards a number of deposits or opening of accounts or something of the sorts? Joe, maybe you want to take this?
Hello. Yes, definitely. Like the war create volatility, especially on commodities like bullion, which from the east side, a lot of people trading bullion. You can see a massive volume boost from this aspect. But at the same time, more deeply, I think like it's about how's the national tensions. Like a few years ago, it's about U.S. and China trade war. And now you got the war, which literally behind is about the Western side and China and Russian tension, which will probably bring a lot of market volatility. Okay, as Iskandar said, as a broker, we have to do a lot of enhance the risk management, which we set up a new dealing desk in Jordan a couple of weeks ago, get licensed locally. So all these things we need to make sure, like from our client perspective, we get good liquidity and also better execution, and of course, like more and different type of variety of products regarding to the situation. Even like Bitcoins or like volatility is definitely there, and from our perspective, we will provide like more commodity for the clients to trade, so that they can like get a chance from there.
Thank you, Joe. Andrew?
Yeah, if I can take, I think we all are familiar with catalysts to volatility and what that means for this market. So I have a few separate perspectives on the Ukraine stuff that I think is relevant to the people in the room in this space. You know, first and foremost at 1.0, one of the biggest impacts of this has been we have employees with families there. We have Ukrainians in the company. We have developers there, and you know, taking care of those people. And there's a real war going on as well too. So first and foremost, I think the effects of this and thinking about those who are affected by it and doing what we can to help them is most important. You know, second of all, taking the non-markets approach. I think the other panelists described well volatility, liquidity, continuity of business, understanding that, you know, we haven't had a war to deal with before. We've done tsunamis, we've done market meltdowns. So this is a new one in some ways. From a technology provider perspective, I have a couple other interesting nuances coming out of this, this crisis. One is tech sourcing. We're a technology vendor, one of the leading providers of risk management aggregation technology for many clients in this room and up on the panel. It's not cheap or easy to get developers today. It's a very competitive market where we are in the US. A great source of high quality developers came out of Eastern Europe for a lot of firms. 1.0 has developers that we've looked at in that region. A lot of firms have come out of that space. There's some great companies coming out of Estonia, Ukraine, Russia as well that are here with us in this room and been very successful in this industry. So there's some disruption happening in developer outsourcing that's interesting. It will put pressure on, I think, some smaller fintech companies. And the other aspect of this that I'm personally very interested in is despite having a ponytail and being in my 30s, I'm not a crypto person yet. I'm on my way there. I'm not a big investor in that space. In being in finance for a long time, I've felt that there's inefficiencies in technology and banking in those systems, and some of those are there for a reason. And I think Bitcoin, crypto, Ethereum all have very interesting use cases. Decentralized finance from a retail perspective and saying, I'm better than having to wait for Bank of America to send my money at T+2, or this can move faster or more efficiently. It felt great, you know, settling our own trades into a wallet and experimenting with this. Now that we see that a stable coin and decentralized finance can also be used to circumvent sanctions and restrictions, and stablecoins can be used to fund a war machine, I'm not sure if we feel as good about how that market should be regulated or managed looking into the future. There's certainly a balance in between. As a technologist, I love blockchain, I love the efficiency of it, but I do believe we're going to start to see regulation in that market, especially stablecoins, and that's likely to come a bit faster as a result of the war and what's happening there.
Since you jumped right into crypto, then we're going to move to the second topic. Unless anybody else has something to add about the war in Ukraine, Russia, the prices, Philippe?
Look, what I can say is, to add what Andrew is saying, is it's dramatic what is going on. And there is a war and geographical change that we are all living. And this is where, as us leaders of institutions, you want to be sure of dealings with two aspects. Number one is how you run your company and how you deal with sanctions, regulations, compliance, and how you're able to inform your IBs and sales associates and VPs, etc., to be sure to understand how they were going to commercialize, how they're going to sell, how are they going to explain to their customers. Because most of the generation that is going through this trading volatility haven't went through 2008 and 1929 and all of those huge volatile markets. And this is where you want to be sure that you explain them what is leverage, stop loss, and also to add on Andrew, what he's saying in terms of the rapidity of funding. And this is where it is important that as institution, we're able to express to our customers that we have the right technology to allow them to fund and to protect their position or to enter a position, and also to understand what kind of position they're taking, because it is not going to be, it's true there is volatility, but we are in an unprecedented time where we have a real geopolitical change that is based on evolution, an evolution of our human race, and we have to accept and respect that there is a new human race which is called artificial intelligence. And artificial intelligence is going to accelerate, and it is accelerating, and it will continue to accelerate the way that we are thinking and the way we are going to develop our companies. And this is something that we should really, as leaders, express to our customers, and us as leaders, as entities, to be sure that we understand what we are really building to project and prepare what is coming next.
Thank you so much.
And just one quick
James?
positive. It's been really nice to see over the course of the last few weeks and months, a lot of people in this industry, our peers, our colleagues, our clients, our vendors, our suppliers, actually reaching out on social media and in the real world and looking to do what they can, because often we feel like there's not a lot we can do. We're an Asian-based prime, Sydney, Australia. If we can employ a Ukrainian lawyer, as we did last week for the very first time from Sydney, Australia, there's a lot that we can all do. And it's been really nice to see the social media reach outs and the real world reach outs that people have made to really try and, I guess, extend a hand and be a human in a tough time.
Thank you, James. So without further ado, we're going to go into the cryptos, since also a very hot and interesting topic. Picking up on what Andrew said, actually, JP Morgan was a little bit of your opinion. They were not very much into cryptos, but they just opened a few months ago an entire branch just for crypto investment, and they have actually made a switch for alternative investments from real estate to cryptos, which was quite shocking. They expect crypto, they say that this is the lowest that it's going to get, and they expect it to go very soon up to 38,000 and more. So what are your thoughts on that? Are we not in a crypto winter? How much longer is this going to last? What's your take on it?
So I guess despite advocating that I'm not a crypto person or investor myself, I've been to a few of these panels before, and I think it was in 2018 that I declared, crypto, not necessarily the future that will replace fiat in 5 years, so I was right there, but also not going away, and certainly something that has utility and use and is proving some interesting demand and use cases within our market. At our conference in November at Finance Magnates London, I said, going into our planning cycle for this year, augmenting a system to have Satoshis or use smaller volume or trade a bunch of different altcoins or even settle on the blockchain is one interesting technology problem. The biggest challenge that I think crypto is placing on the people in this room, and the biggest threat that I think crypto puts on the over-the-counter CFD and FX market, is 24/7 trading, is attracting a client base that we have looked to nurture and educate around a multi-asset set of products. We've grown so much over the last decade in this industry, being regulated, expanding into other asset classes, learning that we have to pay for market data and equities and futures, and it's not like FX. There's been so much we've gone through, and now crypto has come in we're, first of all, applause to us, we're the more regulated party in the room, which is a first for the FX industry, I think. But we're under threat. The crypto firms could just as easily add FX and other assets and start to take away some of that traction that we've gained as a regulated, more centralized market. And that means regardless of what you think about the asset class, taking our companies 24/7 is something that is going to need to happen. We are facing that reality at 1-0. It is not cheap, it is not easy, it is not, oh, I'm gonna ask my operations people to work one weekend a month and hopefully we'll wait this out till the next crypto winter. It's expensive but necessary. And these are major investments that we're making as a company. I continue to encourage brokers to look at crypto and weekend trading not as a marketing exercise. Don't send an email that says we're weekend 24/7 trading now without talking to your technology providers, your LPs, and understanding what that really means and building a proper risk strategy for it. It's coming, and it's an area that we continue to invest in a lot.
Iskander?
I support Andrew in the idea that there's a definite evolution within our space. Are we at the forefront of cryptos? We potentially could be. We have been in the brokerage space, servicing retail clients, brokerage clients across the board for many, many years. So what differentiates us from the larger exchanges that have been set up is experience and time in market. And in terms of 24/7, yeah, without a doubt, there's an expense to support that. There's complexities that you have to navigate through to bring that to life. But on the upside, what the crypto wave has done is generate a huge new wave of traders to the market. And that's a significant opportunity that didn't exist before. You know, trading has become a lifestyle. It used to be an investment. It used to be a small share of wallet. Now it's become a lifestyle. Everyone has an account. The average trader has become 15 years of age, upwards, you know, where it used to be very much an average of about 35 to 55 years of age. So that bracket's changed. The demographics of the market have changed. The size of the market has changed tremendously. And I think it's natural for companies to evolve, expenses to be consumed, but most importantly, like you said, constant conversations between LPs, between tech providers to ensure that everyone is in sync. Because definitely there are going to be challenges along the way. It's not going to be as simple as just adding an additional instrument. There's a whole ecosystem that needs to be adapted to it. And we're at the forefront of that. In terms of cryptos, how we're looking to manage that is we're in the digital asset space in different ways. We're kicking off new projects. We're working with different governments in helping draft legislation towards it as well. But what we've done in a more short-term sense is offer it as a CFD, either leveraged or as a full paid. Now, that's a smaller market segment within the crypto space, but it is a segment that don't want to start thinking about cold and hot wallets, don't want to learn about nodes, they don't want to kind of really delve into that space, but they want to capture the speculative opportunities that exist within that market. And we're facilitating that through some of our regulated entities. We're also quite highly regulated. We're regulated in maybe 7 different jurisdictions, so we're always have our ear to the ground in terms of regulators' perspective and opinions towards crypto. So we have to keep that in mind in any product we roll out, in any solution that we roll out, and that's something that I imagine most brokers who are regulated are considering continuously.
I think that from our optic of finance magnates, we have really seen mass adoption within the fintech space of cryptos as a product. But I'm wondering more about the maturity of cryptos as an actual method of payments. We are seeing more and more, I mean, ourselves, we get more and more requests, can I pay you in crypto, can I pay you in USDT, stable coins, Ether, etc. Do you see the same from your end? Are you personally using cryptos to settle with your providers, to get settlements from your clients? How mature is crypto on the institutional level of our industry?
I can take a little of that, because the only advantage I might have here is that I'm starting from scratch, okay, another new company. So the thing we are looking at is that effectively we're receiving a lot of demands, and we're funding customers. Customers are funding through crypto, but you hit on a point is, are people paying with crypto? And the more it will increase, the more customers will use Bitcoins or other, because again, it's a software. So things are going to come where people will use crypto in different ways. And this is where you will see much more volatility on Bitcoin and other coins that will come at a later stage. So of course you need to focus. Crypto is another asset class. Crypto is another instrument also of different kinds of utility. And generations are being built on that mindset. I wouldn't say ideology, but I would say the mindset to go faster, streaming. The only thing that is not streaming yet is our body. The rest is streaming yet, for now. And this is where I think that crypto we are at the beginning of a very long way in terms of digitalization, automation, decentralization, and all those kinds of tokens that will come up.
Thank you.
I've got a slightly
James.
different perspective, if I may. You know, one of the core strengths of our business is our prime broking relationships. Post the Archegos hedge fund collapse last year, Credit Suisse and many other tier 1 prime brokers have significantly enhanced their due diligence, their KYC requirements, their AML requirements. And when we face into these requirements daily, weekly, quarterly, monthly, we only see the questions around the digital asset space becoming more pointed. And this is not one PB, this is across all 5, 6 PBs. We were directly touched by that Credit Suisse exiting of the market. Fortunately, we've got a very strong panel of PBs, but they're only focusing on this area more and more in terms of their KYC and regulation. So for us, it's not a question of should we engage with the crypto space, should we be there? It's what impact does that have on our core business of providing credit and access to real world markets? Because it's tangible right now and it feels at the coalface very, very tangible. Just coming back to the JP Morgan comment before, JP Morgan has a division called their Onyx division, which focuses on tokenization and digitization of real world assets. These guys are working at a furious pace right now to digitize and tokenize particularly illiquid assets, so listed investment vehicles that don't have a huge amount of liquidity, less liquid funds, and they're looking to tokenize them. Anything that has a long settlement cycle or where title transfer of assets is challenging, they are looking to tokenize it really quick. And that's a challenge, but also if you think about the way that regulation is evolving, like daily, and I mean today there's regulatory updates from the US, this is a huge opportunity as well. So if we think about the challenges of dealing in crypto, and we see that on the PB side, there is immense opportunity on the tokenization side with real world assets, not just Bitcoin, Ether, and actual coins. Thinking about the real world implications of what we can be doing here, it's huge. And for us, that's a lot more exciting than just where's the price of Bitcoin today or tomorrow or yesterday.
Thanks,
That's just
James.
our view.
Thanks. Joe?
Yeah, regarding to your question, yes, from our firm, some of the region we're taking like clients to deposit in USDT. But at the end of the day, it's how confident we are on these kind of coins, even stablecoin or Bitcoins or crypto. It's a realistic question. How many of our operation fund we are willing to put in the USDT? Or we get it from USDT and convert into dollar or currencies. Well, I'm not a big fan of crypto. Well, blockchain is something different. Blockchain is amazing. You're bringing a revolutionary for financial industry. But at the end of the day, like crypto, you're saying like as decentralized. And where's the decentralized now? Right? What we can see is it's all centralized in a couple big exchanges in the world. And what's the difference at the end of the day? And you're talking about payment. At the end of the day, it's about the regulation and how stability is. Because like what happens if next USDT become the next Luna, right? So who can guarantee? No one. And there's no regulation. Who you gonna talk to if you're holding like millions of Luna, right? So, but the dangerous things, I agree with you guys, like our next generation, like I talked to some new friends in Hong Kong. I said like they're working very hard to save money. I said, what are you saving money for? He said, I want to invest in crypto. I said, what? You know what? It's like a gambling now. There's hundreds of crypto. And how deep we are understand of this kind of like new type crypto, what's the potential, what's the reason behind? No. At the end of the day, it's like whether it becomes a gambling game, which is very dangerous for our next generation, if you ask me. Instead of FX, okay, it's a currency exchange. It depends on how strong the nation. But what's crypto? Right? There is some function that we can be used, but as an investment, of course, there's a huge opportunity as a speculation. But we can't make it like you close your eye, buy 1,000 for 100 big crypto each, and then wait it bump for 200%. No, it's not an investment like this. So we've been very stressed on the client education. What's investment? How you to understand your product, okay, and how you stop loss and how's the risk management on our client side. This is very important, I think.
I think just to summarize, I started somewhat dire on the space, and I was surprised to see we all had a similar consensus. But Iskander's point is very important, and I think Joe reinforced it as well, is that a lot of people have opened their minds to investing or speculating or gambling on a financial asset here that now they want to look further into. Whether it's crypto, whether it's FX, there has been a surfacing and manifestation of demand in a whole new generation for trading. And we have to ask ourselves, why didn't we Why didn't we cause that ourselves? Why didn't we bring these people to the table? And now, how do we get these individuals with speculative capital interested in trading assets on margin and bring them into regulated entities on products that they can understand more and put some crypto along the side of it as well? I think we're positioned to do that. And again, at 1.0, we're just very focused on that 24/7 aspect. We have to open up into the weekends. We draw a big Venn diagram of retail client demand. There's speculative traders that want to trade FX and CFDs. We have those. There's people who want to buy crypto and bring it to their own wallet and then put it on a USB key and have it under their bed and treat it as a store of wealth. And I don't know that those people are necessarily going to come to a retail CFD broker. They can go to an exchange and trade crypto. But crypto CFDs are a massive opportunity for this space. Attracting these traders on the weekend, I think, is the name of the game.
Thanks, Andrew. We have, all of you have touched here and there on regulation, so I want to go a little bit into that. The chairman of SISEC was here prior to this panel, and he was mentioning MiCA, so I want to briefly discuss, can a hard regulation like we have in financial assets apply to crypto, considering the nature of tokens, crypto? How do you differentiate between all of them? What are the initiatives that you're involved in? How do you see hard regulation, soft regulation? Where do you see regulation going in cryptos and blockchain?
If you don't mind, so I would like to take just
go for it.
that, because when we looked at that, when we built the ADGM in Abu Dhabi, we really focused on the aspect of the crypto and regulating crypto at the beginnings. It will be very difficult. It will be very difficult. But one thing regulators, when I was hearing the chairman of SISEC, one thing that he is focusing on is supervision and really pushing to the companies like us to be sure that we do our compliance job, that we really, those wallets really have as much as we can, transparency, who's really the OBO behind, and educate as much as we can. But can they really regulate that? I think it will be very difficult on the long run to be able to regulate crypto and all the tokens that will come. We have to bear in mind also that still Forex, CFDs, and gold are still the majors today in terms of volume. And I would agree with Andrew that we are all trying to educate or push those traders to come and trade through institutions like us. Two things that would attract them is, number one, fear, because some traders have lost a lot of money, just disappeared, the money just gone, and to education. And if you're able to attract them into an easy way, the onboarding process is easy, some of them come and trade through us and push it on CFDs, but regulation is very tough for them. This is what I'm seeing.
Iskander?
Yeah, I think markets and capital assets it's a new framework that's coming to existence from a regulatory regime perspective. There's two parts that's looking at, mainly looking at investor protection, maintaining, controlling volatility within those markets. At the same time, anti-money laundering laws, terrorism financing laws, and all those elements. You'd mentioned whether a hard regime would come into play. I think that's quite challenging. I think this is the first of a number of different iterations that will come through, as with any new regulation. I differ with Philippe in the sense that, can it be regulated? I think eventually it has to be regulated. Some of the repercussions that we've seen with Luna more recently is pushing it a little bit further away. And what they are excited about is introducing financial institutions and big ticket funds into that. And you need to have some element of control, of some element of framework around that industry to be able to really evolve and grow and take it to the next level. And we're starting to see a number of different regulators, as Philippe had mentioned with ADGM. More recently in Dubai, they've launched a virtual asset regulatory authority. And we've been heavily involved in building a digital assets association in Dubai, focused on constant dialogue between the private markets and the public markets. And I think that will start to surface and come to life. Listen, it's not going to tick all the boxes. There's definitely going to be a segment of those markets, because the opinion is very polarized within the space. That the technology is too advanced and it wouldn't operate under a regulated environment, and those who believe that in order for this industry to advance, it needs an element of regulation within it. And it'll be a constant back and forth, a number of different iterations on MiCA till it finds that perfect common ground. But I do believe that the future is going to be regulation without hindering innovation, progression within that space.
I mean, one of the main appeals of all these blockchain and crypto and tokens and NFTs, etc., is the hype on being decentralized, right? That the lack of a central authority. However, regulation is evolving and is taking a bigger and bigger part. So how can a decentralized environment be regulated by more and more central authorities? And do we see DAO coming into our fintech industry, for example? Is it something in the future? There is a lot of different industries that are already applying this. There is plenty of events and companies that are auto-organizing themselves with this. Do you see this happening anytime soon, thanks to a blockchain? Does that have a space within our industry? Is it something completely out of it? Joe?
Yeah, definitely. Regulation is a must, if you ask me. Just look at like our industry, FX CFD industry. Now you are trading with exchange, which a lot of exchanges without regulation. Just like our industry, the brokers without license. What's the difference? Right? Well, yes, you can put the money in the cold wallet, but if you have the money in the hot wallet, then this is exactly the same. Then how do I choose? How do we pick? How do we differentiate? Right? So crypto, at the beginning they said it's for decentralized, but I still remain with the decentralized. Now it seems like, okay, for me, it's very centralized in a couple of exchange houses. So if it need to be a decent or rectified financial product, I think regulation is a must for not only from the institutional, but from the investor side, to make sure their money is protected.
Yeah, I'd agree with that. And, just expanding on Iskander's point before, the CFTC and the SEC are debating right now who is going to take the forward role in regulation in the US. I mean, these conversations are being had right now. They're quite robust, but the regulation is coming, and that's only going to be a good thing. So I think for us, the question is, what relevance does the non-regulated market have once the regulators finally come to the table, once they step forward with clear policies? And it may not be a surprise to this particular room that regulators do often move quite slowly. They are quite considered when they look to implement these types of things. But it's coming. And so the question is, what relevance does the non-regulated market have once regulation arrives? And what does that regulation look like for us, and how can we engage with it in a positive way and be, to Iskander's point, engaging proactively now to ensure that the regulation is, I guess, appropriate and accommodative to our industry, but provides the investor protections that Joe's talking about as well.
When you talk about regulation, you talk about enforcement also. And this is where I find it quite difficult. I think the word of saying it's going to be regulated could be said that it will be regulated. How will they enforce it? How will they control it? This is again something that I myself look at it very skeptical. I know it's coming, it might come one point or another, and it will come on what? What is going to be regulated? This is the question. And this is where, as myself, when I look at it, I'm quite, I'm not very familiar how they will do it.
At least like at the beginning, sorry. At least like kind money. For example, if I regulate in ADGM, I got like 10 millions of whatever coin it is. What's the market value? Whether I have the money back up for me to hold the coins here, money is like is the first pass is always. Of course, after that you talk about tax, about the boundary, etc., etc. This is another thing, right? This is the core part of the regulation, if you ask me.
From my perspective, the challenge with DAOs is the ultimate accountability. And I think that's what's being addressed now with the Loomis bill that James was mentioning, that's being discussed in the US Senate at the moment, is registering these DAOs. And once these DAOs are registered, then there's an ultimate accountability. And I think that's the biggest challenge in, okay, you're democratizing regulation, you're making it you're creating a framework for self-regulation, but if things go wrong, who is accountable? and the buck needs to stop with someone. And I think until this starts to come to life, until they shape a framework around it, it's going to constantly be debated till they find that structure. That will attract the institutional funding. And institutional funding will really allow this to have a significant jump in markets.
Traditional market structure and regulations annoying and a lot of speed bumps and we spend countless hours and effort investing in data models and analytics and things that help facilitate regulators. But fundamentally, it exists for a reason, and that is to protect investors, especially regulations around retail. So 100% this industry will be regulated. I think the regulators need to find out what these things are first, and then the CFTC and the SEC in the US will battle who gets it. I think stablecoins, again, as I noted in the intro, they're pretty clearly money market funds, or at least some facade of that, which will be easy to regulate, and I think that will come quick, especially within the United States. Shifting gears slightly, speaking of regulation in the US, there was, I don't know that it made the topic of our agenda today because it's very fresh, but Gensler, there was an article in the New York Times this morning about pay for order flow and equities, which I think will have very interesting connotations to our industry and the people in this room. It's maybe 5 years ago we started talking about this Robin Hood phenomenon of commission-free equity trading, its impact on the FX industry, and again I'm 3/4 of a New York Times article before my coffee into this, so it's relatively fresh. But from what I see, the attempt by the SEC to eliminate pay for order flow and push market orders from retail clients on equities into an auction-only format can only make execution worse for retail, and more so, can only eliminate commission-free trading models. So the article touches on this. I encourage everybody to look at it. This is not an endorsement for the New York Times, but it's interesting to see a regulator actually try to make things more expensive for retail clients in reaction to the GameStop and meme stock phenomenon. It seems like they're indicating they want a less slippery slope to trading for retail, and how that reverberates around our industry and around the world will be very interesting. It's tough to have a similar concept in FX, of course, but certainly regulators will be looking at this and reacting to it around the world.
Thanks. We have 9 minutes left, so as interesting as the topic is, we need to move along. I would like to touch on the Web3 and metaverse, since it's the current hot topic. So, do you see your companies having a plot, having a virtual shop in the metaverse, an avatar, receiving all of these people coming, listening to you, asking about your pricing, doing business in a virtual reality? Where do you see these going?
I personally have a tough enough time explaining to my parents what 1-0 does, trading digital money for digital money on behalf of brokers, let alone doing so in the metaverse. So I think maybe somebody 20 years ago would have said, I don't know if the internet or Web 2.0 is going to kick off. Is the bandwidth there? Do we all want to carry around a device that's constantly connected? And those people would have been wrong. I wouldn't have been one of those people. I'm not sure. You have to wear a thing to get into the metaverse, and I don't see that getting as. I have an Oculus Rift. I love to play the game where you slice things with a lightsaber, but I don't necessarily want to go shopping there. I personally am going to stick in the real world, and if you want to buy a 1-0 hub for the foreseeable future, you'll have to meet us in the real world as well too.
From my side, I think similar to what James said and what Andrew just said, we're getting our head around cryptos and DAOs, and then we're already behind the curve when it comes to the metaverse. But I think, contrary to what Andrew thinks, I think it is going to be a big part of the future. And I think it's how we adapt to it. And I don't think it'll impact us as much as it'll impact our kids, let's say. But from our perspective, yes, we do have an interest in having a plot in the metaverse and setting that up. But I don't think it's going to be transformative towards trading. It's more of a client experience. So in principle today, when a client goes onto our website, it's just a single interaction with that client on our website. What we're able to create with the metaverse eventually would be a number of our clients in their avatars interacting with our website and interacting with the equity experience in a sense. And I think that's the direction that it would take. Not so impactful in the way we foresee it today towards the trading experience and clients in trading with us on that side.
Thank you.
I agree, like metaverse is our next generation things. I'm I'm quite sure not our generation. But what we can do from a broker side is like in iFX, we are creating NFT, our own NFT, by blockchain, offering to our clients as a retention, as a loyalty program, as all this kind of thing, which is by the blockchain. You cannot remove it. Okay, that's the point I can see from metaverse and or NFT can benefit what we are having now, besides marketing. You know what I mean?
To me, the metaverse sounds like very engaging Zoom beers, and I think we've all had enough of those. I'm actually enjoying being back in the real world with all of you and actually having physical beers in person and shaking hands again. So for me, that's a no to the metaverse just for now. But it's lovely to be here and see you all again.
But it's the same. I mean, recently I saw something on social media with Bill Gates explaining the internet to David Letterman. And I imagine in 20 years' time, it's going to be a similar conversation.
Exactly. It's the new internet, it seems, at least.
Yeah.
Diversity of opinions. We'll discuss it more in the next event. I'm sure that by then it will be a little bit more mature. We will all understand better what the metaverse actually is. I want to move because we have 5 minutes left. So I'm going to add one more question on B2B business. And then I'll just ask you to draw some conclusions about what you expect for H2. So maybe we can link them both. Regarding B2B business trends, so it seems like we're moving towards data-driven risk management based on analytics of trading behavior. More and more is about acquiring data, analyzing data, creating algorithms, everything for risk management purposes. How do you build a strategy around that? What kind of services are needed, and how do they eventually serve better the end user, the trader, at the end?
Yep. It's all about data and what algorithm is, which from our perspective, we can get more and more. You can say it's a bank signal, which we are offering in our AT Premium now in Middle East region, which can provide clients more trading option. And the algorithm, it can be a variety of different data combination. And together, we offer like almost 10 trading signal or indicator for our clients so that they can combine their own view of trading to make them make a correct decision of trading. This is what we can do from a broker side to a retail end client. We're not talking about institutional or for algorithm trading. Right? This is what we can do, I think.
I think for us, it's a question of how quickly we can ingest and action those data points within the data models that we're already using and touch the everyday workflows. It's not about AI for us, because with AI, particularly in our space, it becomes a very strong governance issue. You know, how much are you going to leave to the machine, to keep it very, very simply? How much are we responsible for, and should we feel accountable for the decisions that are being made by the infrastructure itself, the suggestions that it's putting forward? For us, the focus now is how do we react very quickly, almost as close to real time as we possibly can, in a way that is responsible for, you know, our own internal governance, the governance for regulators, looking after the outcomes for our clients, the retail brokers around the world, and ultimately their end clients, the traders, our liquidity providers, our prime brokers. You know, these sorts of questions speak to speed and speak to efficiency of data models and data ingestion, data analysis, and then real-time automated application of those. And it's become such a big thing within our business, we actually made a decision somewhat recently to overhaul our infrastructure stack in a very, very meaningful way to better facilitate a real-time data model implementation strategy. And it's been a big job, it's been very exciting, but it's something that we see as absolutely key, the speed with which we're reacting to the data that's coming into our business.
Andrew, the risk management is your playfield.
Yes.
What can you add to it?
Risk management technology is my playfield. I tend to stay away from being a counterparty to trades, and like that neutral position, we'll maintain that indefinitely. James hit the nail on the head. He was almost reading from my marketing material, I think. Data source and analytics has been a major driver for our clients and innovation at 1.0. Users of our hub and risk management technology have always enjoyed performance, stability, where I think we've massively differentiated ourselves from the crowd over the last 2 or 3 years is moving from data reporting and analytics, which have existed in this space for a while. Operating in financial markets lo and behold, we put out a ton of data. There's now scale and capacity to store not only orders, but quotes and information about real-time market data in real time. And as James said, we're ready to move on and have moved on with our clients from analyzing flow from yesterday or the week before, understanding toxicity on a retroactive basis, and using our analytics platform, data source, to feed right back into the hub, to be able to make decisions in real time off of changes in data and transitioning from what we call analysis into true business intelligence. We've talked about that, we've teased it for a few years, we're seeing it with clients in reality today and working very well. And it's a transition that I think is a result of a combination of technology scale and availability and also democratization of some of these tools. It's been going on in the institutional space for a long time. And we in this room and this market have been analyzing client toxicity. We know how to build our A and B books and look at incoming client flow. The amount of good pointed conversations our clients are having with their LPs about toxicity of flow, markouts, cost of rejects, being able to call up the day bad trading and bad flow happens to optimize hedging. It's a real difference in terms of how our clients have been able to use the real-time technology.
Thank you. Iskander, you wanted to add something?
Yeah, just similar to what Andrew and James have said. I mean, data-driven risk management has always been in existence, but it's just the efficiency and manipulation of that data at a mark-to-market pace. And what that's allowed us to do from a B2B liquidity provision perspective is customize liquidity better. It's not one single liquidity solution that a client wants, and being able to put our clients in different cohorts, understanding what their requirements are, that's what we've been able to optimize and kind of expand on our product offering through data.
Philippe, did you want to add something to it?
Look, I look at it as data mining and really it's very important, this whole topic. But what I would underline for leaders of big companies, because the more and more I'm turning around this expo, it's wonderful, and I'm seeing so many companies, and I'm seeing other companies that have become very big and very heavy, and I used to run a very heavy one. And the problem is if you don't automize your company from inside out, and you have all those softwares analyzing this data and a conversation between all the systems that will allow you to be much more efficient. On the long term, you might fail. And when you fail your customers. And this is very important, where we should use the new technology and understand technology, and to be sure we implement it strongly into our institutions to be stronger, because this market is only going to grow,
Thank you all. Our time is up, but I'm going to ask Jenny if I can ask one last question. I don't know where Jenny is. Yes. Yeah? Thank you. Okay, so the last question is just your conclusions. What do you foresee for the H2 of 2022? What do we have ahead of us? Maybe we can start from the end and walk our way here.
Yep. My concern would be the market inflation. After a couple of years, so flooded liquidity in the market, which bring in how our economy will go, and bring to another topic of the market volatility. And at the end of the day, it's about the market liquidity. How's the market depth? Whenever the fluctuation, how depth will be the market? How people risk appetite, or the LPs risk appetite for the market. If it's very thin, then you make our clients' execution, all these things will be very difficult. Slippage will be huge. So that's why we got a huge appetite. Risk appetite, if you ask me. But that's what I'm concerning. Like in the market, how the market maker in the bank or LP non-bank, how risk appetite they are having, so that to create more liquidity in the market for an industry under the big inflation period. So that's I think one of the challenges that we are facing.
I think our perspective on the second half of this year is to keep a close eye on the Tier 1 PB model and even the Tier 2 PB model, access to credit. We've already seen Jefferies looking to exit FX PB. I mean, that transition is still playing out as we speak. Credit Suisse is exiting global prime brokerage. Access to credit and NOP is like oxygen. When there's plenty of it, no one wants to talk about it. As soon as it starts to get a little low, it's the only conversation in the room. And right now it feels like we're stepping into that room. I also sat on a panel here in 2018, I think it was. I think Andrew might have been on the same panel where we were talking about the leverage restrictions being implemented in Europe at the time. I remember saying, look to the JFSA. This has been done before in Tokyo. This is not new. There is regulation. There is precedent here. And if we talk about the regulation of stablecoins and other digital assets, you only need to look back 1 week and the JFSA has rolled out a regulatory framework for retail brokers around the issuance and supervision of stablecoins. And I would be stunned if regulators around the world weren't looking at that JFSA ruling just a week ago and looking at it as their basis for future regulation.
Andrew?
I've talked a lot today, so I'll be a little bit brief in my close. There's a war going on, and we're human beings, and we should take care of each other first and foremost. So I hope when we're here next year, we're talking about volatility driven by the exciting things going on. The interest rate diversion is happening again. There's the return of the carry trade. You know, we spent so much time diversifying into multi-asset CFDs and indices and crypto and everything. Majors in FX are going to move again, and that should be exciting for everyone in this room. Take care of each other, love each other. Let's get through this difficult time for humanity and move on. There's some exciting things ahead for this market.
Peace and love. Thanks, Andrew.
Yeah, I mean, I can't really talk about business after that. So. And no, I support Andrew on that side without a doubt. I mean, it's very important to live in a comfortable world, in a peaceful world. As challenging as it is, you still have to run your businesses and juggle everything simultaneously, which is a challenge in itself. There's a lot of families that we're responsible for. We're over 500 people, and all that is a responsibility. From our perspective on a business front, I think it's scalability. As we've mentioned earlier, there's a wave of new traders coming in. It's becoming a lifestyle. In response to what Philippe has said as well, automation to allow for scalability in the best possible way, relieve human error, allow you to grow without your costs growing at a similar pace. And I think that's our key focus in H2 and be prepared for 2023 as well. Just going back and also data. Being as efficient in having the right data infrastructure and data architecture to be able to better understand our clients, better understand our client needs, and better understand the markets in the best possible way.
Thank you. Philippe?
I will continue on the same note. With love, you can do a lot of things. Build on it, educate, empower the right people, understand people, be understandable, and push people to success. Education, and from our side, of course, fantastic times for us is to grow exponentially, learn from what we've done right and wrong in our industry, and learn from others. You know, just by sitting here, I've learned a lot of things and heard a lot of things. Now heard a lot of things, and now it's a good time to push and to push forward. And I really hope that next year we talk about volatility in a different way, and in years to come.
Thank you so much. Big round of applause to all of our speakers. Thank you so much for all the attendees. You've been amazing.